Hello and welcome to Invest to the Moon, where I share with you the best tips and strategies for successful investing. In today's video, I'm going to talk about William O'Neill's rules of successful investing. William O'Neill is a legendary investor, stockbroker and author who has achieved a return of 5,000% over a 25-year period. He is also the founder of Investors Business Daily, a national financial newspaper, and the creator of the CANSLIM system, a unique method of stock picking that combines fundamental analysis, technical analysis, risk management and timing. If you want to learn how to invest like William O'Neill and make money in stocks, then keep watching this video. So what are William O'Neill's rules of successful investing? Well, he has summarized them into an acronym called CANSLIM, which stands for C. Current quarterly earnings per share, up at least 25% versus year-ago quarter. A. Annual earnings increases at a compound rate of no less than 25%. N. New products, new management and new highs. S. Supply and demand. Stocks with small floats experience greater price rises, plus big volume demand. L. Leaders and laggards. Keep stocks that outperform and get rid of the laggards. I. Institutional ownership. Follow the leaders. M. Market direction. 3 out of 4 stocks follow the trend of the market. When the intermediate trend is bearish, don't invest. Let's go over each of these rules in more detail. C stands for current quarter earnings per share. This is one of the most important factors that drive stock prices higher. O'Neill looked for stocks that had a minimum of 25% to 30% increase in their earnings per share compared to the same quarter a year ago. In bull markets, he looked for even higher growth rates of 40% to 500%. He also preferred stocks that had an annual cash flow of 20% or more above their earnings per share. A stands for annual earnings increases at a compound rate of no less than 25%. This shows that the company has a consistent track record of growing its profits year after year. O'Neill also looked for stocks that had a consensus earnings estimate for the next year that was up 25% or more. N stands for new products, new management and new highs. This indicates that the company is innovating, improving and expanding its business. O'Neill looked for stocks that had new or improved products or services that were in high demand or had a competitive edge over their rivals. He also looked for stocks that had new or improved products or services that were in high demand or had a competitive edge over their rivals. He also liked stocks that had new or dynamic management teams that could execute their vision and strategy. He also favored stocks that were making new highs in price, as this showed that they had strong momentum and market acceptance. S stands for supply and demand. This is based on the simple economic principle that when demand exceeds supply, prices go up, and vice versa. O'Neill looked for stocks that had a small float, which is the number of shares available for trading by the public. A small float means that there is less supply of shares and more potential for price appreciation if there is strong demand. He also looked for stocks that had big volume demand, which means that there was a lot of buying activity by institutional investors such as mutual funds, hedge funds and pension funds. These investors have the power and resources to move stock prices significantly. L stands for leaders and laggards. This means that O'Neill preferred to invest in the best performing stocks in their industry groups or sectors, rather than the ones that were lagging behind or underperforming. He used a metric called relative strength, which measures how a stock is performing compared to the rest of the market. He looked for stocks with a relative strength of 85 or higher, which means that they were outperforming 85% of all other stocks. He also avoided stocks with a relative strength of less than 30, which means that they were underperforming 70% of all other stocks. I stands for institutional ownership. This means that O'Neill liked to follow the footsteps of the smart money, which are the large institutional investors who have access to more information, analysis and resources than individual investors. He looked for stocks that had at least 3 to 10 institutional sponsors, which are institutions that own at least 100,000 shares of the stock. He also looked for stocks that had to increase institutional ownership over time, as this showed that more institutions were becoming interested in the stock. M stands for market direction. This means that O'Neill paid close attention to the overall trend of the market and adjusted his exposure accordingly. He observed that 3 out of 4 stocks follow the direction of the market, so it is important to invest when the market is in an uptrend and avoid investing when the market is in a downtrend. He used various indicators and tools to identify the market trend, such as moving averages, price and volume action, distribution days, follow-through days and market indexes. So these are William O'Neill's rules of successful investing. As you can see, they are based on sound principles and proven methods that have helped him and many other investors achieve outstanding results in the stock market. If you want to learn more about his CANSLIM system and how to apply it in your own investing, I highly recommend you read his book, How to Make Money in Stocks: A Winning System in Good Times and Bad. I hope you enjoyed this video and learned something valuable from it. If you did, please give it a thumbs up and subscribe to my channel for more videos like this. Also, leave a comment below and let me know what you think of William O'Neill's rules, or if you have any questions or suggestions for future topics. Thank you for watching, and I'll see you in the next video. Happy investing!